So your credit score is a 3-digit number that can cost you hundreds of thousands of dollars over your lifetime or save you the same amount. What's the difference between a 650 and a 750 credit score? That's over $60,000 in extra interest on just a typical mortgage alone. But here's the crazy part. Most people have no idea what actually makes up their credit score, right? They're making financial decisions in the dark, wondering why their score keeps dropping. And I'm going to tell you why. Next 15 minutes, I'm going to break down exactly what controls your credit score, expose the myths that are probably hurting you right now, and give you the exact blueprint to build an excellent credit score from scratch or fix the damaged one, right? So if you want to save tens of thousands of dollars, qualify for better loans, and unlock financial opportunities most people never get access to, you need to watch this entire video, and let's get into it. So what's up, everybody? Welcome back to the channel. But before we get started, I wanted to let you guys know to check out the description below. I dropped some extra resources down there with extra links, right? And if you're new here, I break down personal finance topics that actually matter to your wallet, right? We're going to sock it to your pocket. No fluff, just actionable information you can use today. Now, your credit score is basically your financial reputation score. It's a number between 300 and 850 that tells lenders how trustworthy you are with borrowed money. And whether you like it or not, this number affects almost every major financial decision you'll ever make, right? Want to buy a house? They'll check your credit. Want to rent an apartment? Credit check. Financing a car? Credit score. Getting a new job in certain industries? Yup, credit check. Even getting a cell phone plan, you guessed it, checking your credit. The higher your score, the better interest rates you get, which means you pay less money over time. The lower your score, though, the more expensive everything becomes, or worse, you completely get denied. Here's what makes it so frustrating. The credit score system isn't exactly transparent, but today I'm pulling back the curtain. We're going to break down the 5 factors that make up your credit score, exactly how much each one matters, and most importantly, what you can do about each one starting right now. By the end of this video, you'll understand credit better than 95% of the people out there today. So let's get into it. Okay, so before we dive into the 5 factors, you need to know that there are actually different credit score models out there. The 2 main ones are your FICO score and your Vantage score. Your FICO score is like the OG, is used in about 90% of lending decisions. When a bank or mortgage lender checks your credit score, they're almost always looking at your FICO. Now you have Vantage score, which is newer model, right? Which is a newer model created by the 3 credit bureaus, Equifax, TransUnion, and Experian. It's what you usually see when you're checking your own credit on apps like Credit Karma or Credit Sesame. Now here's the thing. Both models use similar factors, but they weigh slightly differently. Your FICO score and your Vantage score won't be exactly the same, but they'll be about close enough in ballpark range, right? For this video, I'm focusing on the FICO model since that's what most lenders actually use. Everything I teach you will apply to both models though. But if you're trying to optimize your score, focus on FICO. So now that we have that out the way, let's break down the 5 factors that control your credit score. So factor number 1 is payment history, 35%. Factor number 1 is the biggest piece of the pie, payment history, and it makes up 35% of your credit score. This is simple. Do you pay your bills on time or do you miss payments, right? Every time you pay a credit card, a loan, a mortgage on time, that's a positive mark to your credit report. Every time you're late or miss a payment, that's a negative mark and it tanks your score. And here's what most people don't realize. Just one missed payment can drop your score by 100 points or more, especially if you have a good score to begin with. The higher your score, the harder you fall, right? What counts as payment history? A few things that count as payment history is things like your credit card, auto loans, student loans, mortgages, personal loans, even sometimes utility bills and phone bills if they've been reported to the credit bureau. This is what you need to know. Late payments stay on your credit report for 5 years. Stays on your credit report for 7 years. But the good news is that impact fades over time. A late payment from 3 years ago hurts less than one from last month, right? Payments that are 30 days late get reported to the credit bureaus. So if you're 5 days late, you're fine. Just pay the late fee. But if you hit that 30-day mark, it's getting reported to your score and it's going to take a hit, right? It's getting reported to your credit report and your score is going to take a hit. How to master payment history. Step 1, I would say, is to set up automated payments, right? At least make the minimum payment on everything. I don't care if you think you're going to remember, automate it, right? Use your bank's auto pay or bill pay and set up auto pay and pay with your credit card. Step 2, set up calendar reminders a few days before payments are due. This gives you a backup system. Step 3, if you do miss the payment and catch it before the 30 days, pay immediately and call the creditor. If this is your first time and you've been good with payment history, they might not report it. Step 4, if you have old late payments on your credit report and you've been perfect since then, consider writing a goodwill letter to the creditor asking them to remove it. It doesn't always work, but sometimes it's worth the try because they'll give you a courtesy. The bottom line is payment history makes up 35% of your score. Never ever miss a payment. This is non-negotiable. So factor number 2, credit utilization, 30%. So factor number 2 makes up 30% of your credit score. And this is where I see people make the biggest mistakes, credit utilization, which is the percentage of your available credit that you're actually using, right? Here's the formula. Take your total credit card balances and divide your total credit limits. That's your utilization ratio. I'm going to give you a quick example. You have 2 credit cards. Credit card 1 has $5,000 limit with a $1,000 balance. Card 2 has a $5,000 limit with a $2,000 balance. Your total credit limit is $10,000. Your total balance is $3,000. $3,000 divided by $10,000 equals 30% utilization, right? Here's what you need to know though. The lower your utilization, the better. Ideally, you want to be under 30%. But if you want an even better credit score, aim for under 10%. People with an 800 plus credit score typically have utilization under 7%. And here's the kicker. Utilization is calculated in 2 ways. Overall across all cards and per individual card. So even if your overall utilization is low, maxing out one card can still hurt your score. Here are some common myths that destroy your credit scores. Myth number 1, I should carry a balance on my credit cards to build credit. Wrong. You do not need to pay interest to your credit card to build credit. Pay your statement balance in full every month You'll build credit and save hundreds or thousands of dollars in interest. Trust me. Myth number 2. Closing a credit card will help my score. Wrong again. When you close a credit card, you lose the available credit, which increases your utilization ratio. Keep the old cards open even if you don't use them. And myth number 3. My score only cares about what I owe when the statement closes. This is actually true. Your utilization is typically reported when your statement closes, not when your payment is due. So here's a pro tip. If you have high utilization, make a payment before your statement closes to lower what gets reported. Now, how to optimize credit utilization, right? I'm going to give you a couple strategies for this. Strategy number 1. Pay down your balances. This is the most obvious, but the most effective. Strategy number 2, request credit limit increases. Call your credit card companies every 6 to 12 months and request an increase. This increases your available credit, lowering your credit utilization ratio. Just don't use the extra credit to spend more, right? Strategy number 3. Make multiple payments per month. Instead of one payment after your statement, make payments throughout the month to keep your report balance low. That's always important, right? I do that a lot. Strategy number 4, get a new credit card. This increases your total available credit, but be careful. This only works, if you do not increase your spending, right? Don't get a new credit card if you're just going to max it out. I'm not asking you to do that. Strategy number 5, use the zero balance trick. Pay off your credit card before the statement even closes so it reports a $0 balance. So many people with 800 plus credit scores do this. Use the zero balance trick. Pay down your statement to $0 before the statement closes. Credit utilization is 30% of your credit score, right? Keep the balance low and watch your credit score climb. So factor 3, length of credit history, 15%. Factor number 3 accounts for 15% of your score, right? Length of credit history. This measures how long you've been using credit. The longer your credit history, the better. FICO looks at 3 things here, right? Just 3. The age of your oldest accounts, the age of your newest accounts, and the average age of all of your accounts, right? Combined. This is why time is your friend when it comes to credit. Someone who's been responsibly using credit for 10 years is less risky than someone who just got their first credit card 6 months ago. But I'm going to tell you a problem, right? You can't fake time. Not at all. If you're young or just starting out to build credit, this factor will naturally be lower, right? But here's what you can do. How to maximize your credit history length. I'm going to give you a few strategies to follow. Strategy number 1, start building credit as early as possible. If you're 18, get a secured credit card and become an authorized user on your parents' card, right? The earlier you start, the longer your history. Strategy number 2, never close your oldest credit card. I don't care if it has a terrible design or you never used it. The old card is padding your average age of accounts, right? Put a small subscription on it, set it on auto pay, and forget about it. Strategy number 3, be strategic about opening new accounts. Every new credit card you open lowers your credit score, right? Average age of accounts overall. That doesn't mean don't get new cards. Just be intentional about it, right? So strategy number 4, become an authorized user on someone else's old account. If your parents or your spouse have a credit card they've had for 15 years, let's say, with perfect payment history, ask them to add you as an authorized user. That account's age and history can appear on your credit report. You don't even need to have the physical card. And strategy number 5, keep a mix of old and new accounts. Don't go on a spree opening 5 cards in 1 month. Please don't do that. Spread it out over time. Now here's the reality check. If you're just starting out, you won't have a 15-year credit history, right? And that's okay. Focus on the factors you can control, like payment history and utilization, and let time do its thing with this factor. And remember, 15% is significant, but it's not the majority of your score. So don't let this discourage you if you're new to credit. So factor 4, credit mix 10%. Factor number 4 is credit mix, and it makes up 10% of your credit score. Credit mix refers to a variety of credit types you have. FICO wants to see that you can handle different kinds of credit responsibly, right? The main types of credit are revolving credit, which is credit cards, lines of credit. You can borrow, repay, and borrow again up to your limit, right? That's all those types of credit. Then you got installment loans. These have fixed payments over a set period of time. Think about your auto loans, student loans, mortgages, personal loans, right? Having both shows lenders, you can manage different repayment structures. But here's the important part. Do not, I repeat, do not open accounts just to improve your credit mix. This is only 10% of your score. Taking out a loan you don't need just to have a better mix is financially stupid. Don't do it. If you naturally have a mortgage or a car loan or a credit card, great. You have a good mix, right? If you only have credit cards right now, that's fine too. Don't stress about it. This is just a small factor. The reality is, most people build credit mix naturally over time, right? You might start with a credit card. Then you might end up with a car, so you have a car loan. And then eventually a mortgage when you buy a house. That's a natural progression. That's okay, right? What you should do is this. Focus on the big factors. Remember we said payment history and utilization. If you happen to have different types of credit, awesome. If not, don't lose sleep over it. Trust me. The exception, if you only have an installment loan and no revolving credit, consider getting at least 1 credit card or vice versa. But again, only if it makes financial sense to you. Factor 5, new credit inquiries 10%. The 5th and final factor is new credit, also called hard inquiries. This makes up the last 10% of your score. This looks at how many new accounts you've opened recently and how many hard inquiries you have in total, right? What's a hard inquiry? When you apply for credit, which is a credit card, auto loan, mortgage, or personal loan, your lender pulls your credit report. That's a hard inquiry and it shows up on your report. Each hard inquiry can drop your score by about 5 to 10 points, and it stays on your credit report for 2 years, although it only affects the score for about 12 months. Now, what's a soft inquiry? A soft inquiry is when you yourself checks your own credit, when a credit card company pre-approves you, or when a potential employer checks your background. Those are soft inquiries and they do not affect your credit score. Here's what you need to know. Opening a bunch of new accounts in a short time looks risky to lenders. It signals desperation and potential financial trouble. But there's an important exception, which is rate shopping. If you are rate shopping for a mortgage, auto loan, student loan, FICO knows you're comparing rates. So multiple inquiries in the same type of loan within 14 to 45 day window, depending on the FICO version, count as just 1 inquiry, Always remember that. This means you can shop around for the best rate without destroying your score. Now, how to manage new credit. I'm going to give you a few strategies. Strategy number 1, only apply for credit when you actually need it. Do not apply for 6 credit cards in 1 month just because you got pre-approved. Strategy number 2, space out the applications. If you're building credit and want multiple cards, space them out by at least 3 to 6 months. Now, strategy number 3, do your rate shopping within a short window. If you're buying a new car, do all your loan applications, let's say within about 2 weeks span. Strategy number 4, use pre-qualification tools. I stress this a lot. Many credit card companies offer pre-qualifications that only uses a soft pull. You can see if you're qualified to be approved without the hard inquiry. I can't stress that enough. Use that first before you just go out there applying to credit cards. And strategy number 5, avoid retail store credit cards unless you really need them. That one-time 20% discount isn't worth the hard inquiry and new account. The bottom line is this: new credit is only 10% of your score. Don't be paralyzed by fear of inquiries, but also don't be reckless. Be strategic and you'll be fine. So let's bring it all home. Here's the complete breakdown. The 5 factors that make up your credit score. Payment history, which is 35%. Pay everything on time, every time, and automated. Credit utilization, which is 30%. Pay before the statement date closes. Length of credit history, which is 15%. Keep old accounts open and start building credit early. Credit mix, which is 10%. Have a variety of credit types, but don't force it. New credit, which is also 10%. Be strategic with applications, but space them out over time. Now, I'm going to give you a quick win action plan that you can follow. If you want to improve your credit score in the next 30 to 90 days, focus on the big 2, payment history and credit utilization. Make sure every payment is on time. Even one missed payment destroys months of progress. Pay down your credit card balances. Getting your utilization from 50% to under 10% can boost your credit score between 50 and 100 points. Request limit increases, right, on all your existing credit cards. This instantly lowers your credit utilization ratio. Check your credit report for errors. Go to annualcreditreport.com and pull your free credit reports for all 3 credit bureaus. Dispute any mistakes you find. Those 4 actions alone can transform your credit score. So let's wrap this up with your action steps, right? Here's exactly what you can do after watching this video. Step 1, check your credit score for free. Use Credit Karma or your credit card app or annualcreditreport.com. You can improve what you don't measure. Step 2, set up automated payments on every single account today. This protects your payment history, which is 35% of your credit score. Step 3, calculate your credit card utilization. If it's over 30%, make it a goal to get it under 10% in the next 90 days. Step 4, review your oldest credit card, right? Make sure you're keeping it open and active. Put a small subscription on it if you need to. Step 5, create a credit building calendar. Set reminders to check your score quarterly. Request credit limit increases every 6 months and review your credit report annually. So remember, your credit score isn't just a number. It's the key to your financial opportunities. It's the difference between paying 3% interest on a mortgage versus 7%. It's the difference between getting approved for your dream apartment or being rejected. The good news, now you know exactly the system that works, right? You're no longer guessing. You have the blueprint. If this video helped you understand your credit scores better, hit the like button, subscribe, and turn on your notifications because I drop personal finance videos like this every week. Drop a comment below and tell me, what's your current credit score range? And which of these 5 factors are you going to focus on first? Your credit score is in your control. Remember that. Now go build that 800 credit score, and I'll see you in the next video.